Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hi, Jim. Yep, it's a damp Friday here in Vancouver, but it's a Friday.
Bob, we'll start off the show by answering a couple of listener questions. And this question comes from Henry Solomon. Henry asks, Bob, remember that old saying, real men trade the long bond? The long-dated U.S. Treasury securities are represented by the TLT ETF, generally in an uptrend in 2020. The TLT went through some wild gyrations in March. What's the story here with our long bonds? And will this trend continue to decline until later in the fall to be accompanied by another decline in U.S. stocks?
Yeah, that's a broad question, but I love that old saying. I've been using it for ages, that real men trade the long bond, and it goes back to about 30 years ago when a bond market was developing in Europe, but there they mainly traded the 10-year. And, of course, on trading bonds and the percent changes, you get the biggest bang with a low coupon, like the low interest rate, and the longest term. So then playing a 10-year is the safe way to play the bond market, and the line was, and I still love it, real men trade the long bond, and that's where the big action is. So, and of course then as Henry goes on, the bond prices, either the TLT ETF or the bond future, went through huge violence with the panic. And of course, what happened is about December, the bond future bottomed and was quiet, and then became the safe haven trade in case something went wrong with the stock market. And of course, when the stock market went wrong, the bond rallied up to 185. Huge move. So it went from a quiet safe haven trade to reckless speculation in only a few weeks. But anyways, if you had been trading it, and if you were in the 10-year term, you would make that much money. And if you were in the 20 or 30-year bond, you'd make a heck of a lot more. So there, and real men would have traded the long end, that's for sure. So now, the other part of the question is, would the decline in the TLT or the bond future continue later in the fall? No, it's sort of like it's basing here at this level. And you've got a favorable seasonal for the long bond into late September, notwithstanding what may go on in the bigger stock markets where the speculation has been very intense in equities. And also there's been very strong buying of low-grade bonds, and, it's all highly speculative. But, of course, part of this is the problem whereby yields have been artificially lowered, and then pension funds have to get a certain return against known actuarial costs. So they've been then forced to reach for yield and take on risk. It's this game that has forced interest rates so low is truly evil. I'm going to mention why it's evil. It's because the central bankers have a theory that if they push credit into the market, it makes the economy go. And of course, if you look at the business cycle for hundreds of years, you'll know that on a business expansion, credit expands. But the fools in academia and in central banking have concluded that it's the credit expansion that forces the business expansion. But this is getting causation confused with correlation. Yeah, the two go together. But it's a more sophisticated version of noticing that in the morning as the sun comes up, roosters crow, therefore causing the sun to rise. And it's the same logic. The term for it is a primitive syllogism, and it's in full practice at central banks. But the economy you can't force economic growth by forcing credit out. So then what happens is the public decides that the credit is not going to go into the economy, but it's going to go into asset speculation, of which the long bond is one of them, and you have extraordinary low interest rates and the condition whereby otherwise normal risk-avoiding investors are rummaging around in the junk bin. So, the theories and practices behind this are evil, and it will at some point become a disaster. We don't know when yet, but we're looking for the bond to rally into late September.
We have another question for Bob. This question: assuming a sell-off in the equity markets this fall due to liquidity problems, will commodities and so-called safe haven utility stocks also sell off again? Also, it seems that silver is extremely overextended. Could silver crash again along with the equities market as it did in March? And Bob, one last question. In terms of seasonality, have we seen the highs for the year in gold and the gold miners?
Yeah, good question. Yeah, we'd look for a rally in the disaster items out to around mid-year, and then after August it would turn to the problems you can find in the fall, and I think this is going to turn out. There will be. So at the moment, the old guys who were awfully disappointed that the 1970s and inflation came to an end, but they're always expecting that when the Fed depreciates currency by issuing too much credit, they always assume that it's going to go into inflation, like wages and salaries and consumer goods. But no, the public chooses what will be inflated, and for the last while, the inflation is in financial assets. And it's only recently that you've had the combination of a rebound in commodity prices at a time when the Fed is being extraordinarily reckless. So this has got all of the old ancient inflation bugs outgoing and say that this is it. In 1970s, inflation is back, but don't think so. A rebound, yeah. We also had a long-term buy on the grains, but that was a separate market. But the action in crude oil and in base metals is likely completing, and we look at the seasonality for crude, that after September, that thing can head south down into January. So on the question about will commodities be a safe haven, don't think so. We're in a post-financial bubble world where many asset classes can get beaten down, and the utility stocks, I don't so. There's actually, Jim, said the old saying is that when the stock market becomes obviously excessive, some fund managers will realize that and say, well, we've got to buy some defensive stocks. And, of course, those are stocks that'll go down slower in a bear market. But it's the cult, the equity cult, that you have to be invested in equities. So then when you see a setback coming, you get in so-called defensive stocks because you have to be. If you're an equity manager, you have to be an equity manager, and many don't have the privilege of stepping right out of the equity market. So, no, there's no real safe haven. Even the gold stocks, which can perform exceptionally well in the post-bubble world, which they have done lately. My gosh, they've outperformed the senior stock indexes brilliantly after underperforming in the bear market for precious metals from 2011 right down to 2018. And then since then, gold's real price has been going up, and gold stocks relative to the S&P have been going up. Well, they're outperforming terrifically, which is another feature of a post-bubble contraction. However, gold stocks and the action in gold and silver became overbought a week and a half ago, and we put out memos on that. They were all our bells and whistles were going off, and the correction has started. I mean, this question is obviously based on a week ago, and much has changed since, but it was certainly to the point, and we think we should be able to get technically the next low for precious metal stocks. And in the meantime, we had suggested, as it was peaking, that investors and traders both should take some money off the table in the gold sector because the action had been so good. Some individual stocks have been brilliant. So, interesting markets, Jim.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Bob Hoye. Bob, what are the business headlines that caught your eye? U.S. home prices climb as buyers seek space.
Yeah, there's something going on. You got an exodus from city cores to further out, which is put buying pressure on, or construction more. The home builders sentiment number is to the moon, and lumber, which was, I think, 275 early in the year, today is trading at over 800, 820, I think is what I saw. So, and it really is an outstanding straight up action in lumber. So, getting measurably overdone. So, this is part of all of the flux and changes of things that are going on these days. And, as I said, people are moving from inner city cores out to somewhere where they think they can have peace and quiet. I hope they do.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, an attention-grabbing headline. Desperate investors looking for some kind of return are turning to triple C rated debt. Isn't that deep into junk bond territory?
Oh, yeah. Yeah, it's sad to see, as I mentioned, the artificially low interest rates is setting up disasters whereby people have to reach in for yield, and in reaching for yield, they're taking on risk. And Mother Nature is quite implacable about that. At some point, the valuations and adjustments for risk are going to go back to a normal condition. So, again, it's another example of the evils of intervention of central banking, and I hope it soon goes away.
Well, with these ultra-low interest rates, if the idea is to drive the economy back to a normal state, well, then Japan, which has had low and negative interest rates for 30 years, should be booming, but it isn't.
Oh, yeah. They turned on the taps shortly after. They had the unique stock bubble, and it completed, I think, the last trading day of 1989. And at that time, Japan was the daring, dashing action. They had the financial, they called it Zytec, which was financial engineering. There was some kind of a warrant deal going on where effectively companies could raise money for no cost. And then they went out and with their fabulous stock market when, say, New York wasn't, or Toronto weren't performing, the big action was in the Nikkei. And of course then, with big players making a lot of money, they then had to go and buy trophy hotels or trophy golf courses. And I remember one about buying Pebble Beach in California. And the guy paid a huge price for it. And before he could actually conclude the trade, I think, it was only less than 6 months later, that the market broke. The speculative action in Tokyo broke, and so did this guy go broke. And I think the loss, when you take it, maybe he lost $500 million on the golf course. And when you work that out per hole, it was quite a bit. So this, again, is an example. And then shortly after that, the highly rated Japanese government agency, I think it was MITI, M-I-T-I, was the greatest thing that ever happened, and nothing can go bad, and then crash went. But shortly after the crash started, the Japanese authorities turned on the money taps, and effectively they've had the money taps on since, and they're really showing that these theories don't work. So we'll see. I think that on the next phase of this contraction, every country will suffer, and I think it could get bad enough where eventually the public demands that the central bankers be constrained from reckless action, and there's only one way to do it, and that's when you go to a gold standard. And I think the public is out to reform big government. It's going to go back from government by experts to government by the people, and with that they will have to have, or they will demand, a sound currency. And the only way you can get a sound currency is by gold convertibility, and I believe it will happen at some time.
Bob, thank you so much for chatting with us.
Well, Jim, here we had a chance to get together, and I'll look forward to getting together with you again next week.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. As you've heard, Bob loves to answer your questions. You can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.